Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you guys how to make smarter option trades. And today we're going to go over all of our opening, closing, and adjustments that we made here for Monday, July 7th. I've also got two trades in here that I didn't cover in the weekend alert because of the holidays on Thursday last week, so July 3rd. So I'm going to cover those two trades. They're just two very small closing trades but profitable trades on V, which is Visa, and X, which is US Steel. But actually tonight, I'm going to start the video by not covering the opening or closing trades first, but actually kind of skip down right to the adjusting trade, which is our UAL adjustment that we made today. And I want to spend a little bit of time on this because I think it can be a little bit confusing for some people about how these adjustments work. So what we had originally with UAL was a very wide strangle. So we had a very wide strangle on UAL. We had the 40 and the 50 strike on UAL. Now here's a chart of UAL. I think it might be better sometimes just to visualize where our strikes are on this chart. So originally, like I said, we had the 40 strike, which was here roughly, and then we had the 50 strike, which was all the way up here. So very wide window of opportunity for UAL to move. And we kind of traded this right around here. So we gave a little bit more upside room potential, but as you can see, UAL has continued to move lower all the way through kind of the midpoint of this expiration cycle. We still got about 11 days to go, but it's definitely starting to test us on the lower side. Now what we did originally was move down this upper strike, or kind of roll down this strike to the 42. So we went really, really close here just a couple days ago. I think it was last week we actually made this adjustment and rolled this 50 strike, which was practically worthless. You can go back and watch that video as well. Practically worthless all the way down to the 42. So again, trying to move as aggressive as the market has moved against us. By doing that, we took in a nice credit on that 42 strike. So we ended up with last week the 42.40 strangle. Well, today UAL continues to move lower, and it was down another 3% today, but implied volatility still remains very high in the stock. So what we did here is continue to be aggressive in rolling and adjusting this position. And now we've moved the 42 down to the 39 on the call side. So we have gone inverted on this spread. Inverted meaning that our put strike is above our call strike. So we have the 40 puts, which are right here, and then we have the 39 calls, which are right here. So we have the 39 calls, the 40 puts. We are inverted on this spread. Now, the whole idea of doing this is to take in a very large credit. So now that we're inside about 12 to 10 days to go till expiration, we're going to start seeing time decay kind of erode these positions very quickly. So it's kind of one of those points where we have to make an adjustment, and we've got to make it quick. We can't wait until the last day because there's going to be nothing left to adjust and nothing left to take in a credit on. So we had to make this kind of early in the cycle, and obviously we can continue to move this if we want to and continue to adjust this lower, but the ideal opportunity right now is going to be actually to close out this trade for a small profit or even a scratch if we need to in the next couple days. Hopefully we get a nice little bounce in UAL in the next couple days. But in this whole time period, as I've continued to say with coaching members and even on this blog with a lot of these alerts, is that if you are going to make this adjustment, you've got to take in more credit. So the whole idea here is take in more credit, build up this massive reserve bank of credit, which helps move your break-even points further and further outside of the market right now. So if you go back to the trade or to the alert section of the website, you can see that today we basically did this via a vertical spread. So we sold the 39, bought back the 42 calls, which we were short. The net difference between rolling that 42 call down to the 39 was that we took in an extra credit of 80 cents. Now in the overall position, after all of the entries and exits and rolls and all of that stuff, we still have a total credit that we're working with of 293. So that's our total credit, meaning that as long as we buy this spread back, this 39.40 inverted spread, as long as we buy it back for at or less than 293, we actually make a profit. So you got to kind of keep track of this, and maybe even a little sticky note on the side of your computer or your desk, keeping track of these spreads, making sure that you remember all of these credits that you're receiving, because each time we roll this thing down, we're actually receiving more credit all the way. If I actually go to the Analyze tab here on Thinkorswim and we take a look at where UAL is, and let's go to the risk profile here, you can see we have a very, very familiar looking inverted position on UAL. And obviously, the position that we have right now shows that we could still make money here inside this range that UAL is trading. And that's the ideal situation because we rolled down that top side, but it doesn't even account for the fact that we have this other credit that's kind of banked that we've already made. So that really kind of moves our break-even points out near 37 and a quarter, 37 or so. So that moves our break-even points even further than what you actually visually see on the chart. Because remember, what you see on the chart right here is just these two open positions. So our 39 strike call and our 40 strike put doesn't take into account that we've already rolled this thing down twice and taken in and banked a credit on both of those rolls. So a little bit of a drawback to the system, but it doesn't know that you're kind of mentally keeping track of that credit. So again, the ideal situation here is that UAL, from where it's at right now, starts to trade just a little bit higher, and as time decay and erosion starts to happen, we'll start to see a profit start to materialize a lot quicker in this trade. All right, so let's jump back up to the top here and talk about some of the opening trades. The first opening trade that we had today, and we were very busy in the market today, was FCX. We traded a broken wing butterfly in FCX, very similar to what we typically do here at Option Alpha, where we did the 38, 39, and then skipped over. You notice we don't do the 40, but we skipped over the 39 and bought the 41 calls. So again, bought the 38s, sold 2 of the 39s, or twice as many, and then skipped over the 40 and bought those 41 calls. Now by skipping over that 40 strike and we're buying a cheaper option out at the 40 strike, that allows us to then take in a credit on this trade. So we took in a nice 9-cent credit, moves our break-even point out to around 40 or so for FCX. And really the whole idea here is that we just don't think that this thing has a lot more room to run. I mean, look at this kind of exponential move that's made in the last month and a half. So we're betting that at some point we're going to see a market, kind of go back to a mean type of area where it has a little bit of a reversion. People start to, close out of their long position here that they've made money on. But our break-even point is all the way out here at 40. So we're still leaving a little bit of room in case the market does rally up another $1.10 or so between where it is now. And as long as FCX trades anywhere below that level, we actually make money on this trade. A little bit of money because we took in a credit, but money nonetheless on this trade. I want to go to the chart here of FCX so you can see visually what the Analyze tab looks like. And you can see now we have that broken wing side over here. This is our broken wing. And it has this very, very similar and distinct butterfly pattern that you would see, except for here, instead of kind of going out this way and making it just a very even butterfly, we skipped over that 40 strike, went all the way down to 41, and bought that side. So all of our risk is to the top side above 40. We make the vast majority of the money as long as the stock closes between 38 and 40. Now that's obviously the ideal situation. If that happens, great. But if not, we still have no risk to the downside because the stock can continue to move all the way lower below our 38 strike, and we still take in that 9-cent credit on this trade. All right, the other trade that we made here today is in WAG, which is Walgreens, one that we haven't traded in quite a while and has really, really good implied volatility right now, even though it's after its earnings season. So we sold just a 1-lot strangle, keeping this very small. This is a naked position on both sides, very similar to our UAL position where we're naked on both sides, and sold the 80 calls on the top side and the 65 puts on the bottom side. Took in an overall credit of 127 on this whole trade. Very, very happy with what we got here with WAG. And you can see when I go to the chart here, the 80 and the 65, just had to double check myself, that with Walgreens, we had really, really high implied volatility up in the 82nd percentile, which we rarely see, right? And we're after earnings. So it did have a little bit of a dip in its implied volatility right after earnings, but has continued to stay very, very high. So option premiums are really, really rich in this stock right now. And you'll see that our 80 strike is above the market. It's not even on the chart here. And then 65 is all the way down here. So we have a very, very massive range for the stock to trade in for the next month and a half, which gives us a huge opportunity to make some money. We don't expect to hold this all the way to expiration. We'd likely get out at about a 50% gain. So as soon as we make about 50% of the credit that we've already taken in, that's ideally when we'd exit this trade, but leaving a little bit of downside room just in case the market gets a little hairy here and starts to move lower. I doubt that there's much more room upside left in this stock, but if there is, we definitely have some room on the top side as well. again, very, very good trade. Like this trade a lot, but keeping it small with these strangles and naked options because they are undefined risk, so they do eat up a lot of margin in your account. All right, so the next trade that we made today is just a very simple debit put spread in BBRY. BBRY has continued to move higher, and I know a lot of coaching students actually have this and kind of were betting on it going higher. So sorry, guys, but I kind of think it's going to move lower in the next couple days here, and so I definitely want to see that happen. And with implied volatility low, the only really option we had here, no pun intended, was to buy the 12-10 debit put spread in BBRY, which was for $1. So all we're doing here is betting that BBRY goes down by buying the 12-10 for $1. That moves our break-even price to right around $11 or so, and that's obviously where we want to see the stock. And again, we've seen moves like this for this stock before, where it's had this kind of huge parabolic move, and then it's settled down into a range, right? And that's what we're hoping that we see now. It's this huge parabolic move and just a slight settling down into a range around 1050 or so. I'd be very happy with that. Have a great opportunity to make some money in this trade. But with implied volatility low, there's not a lot of choices to sell premium in this particular trade. All right, and then let's go over some of the closing trades. So again, these two trades that we're going to go over, these are from Thursday last week when we had that short day and short week, both of these trades. Both of these are very simple debit spreads that we were long. So we were long a call spread in Visa, which is V, and long a call spread in X, which is US Steel. Both of them had great moves on Thursday as the market closed on the highs. So we want to take these off at nice profits. On Visa, we sold back to the market our 205, 210 call spread, a very wide spread that we bought for around $5 or so, and sold that back to the market for $6.95. So it took in a nice profit of $145. Again, very small trade, small little profit on this trade, but something to keep us active in the market as the stock continued to rally higher. Same thing with X. So X is another one that continued to rally higher and really has just continued to move higher and higher. Sold that one back to the market. It was our 25-27 call spread for $1.33. So in this one, we made about $35 on each trade, so about $70 overall. Again, small position, but with a 50-50 trade originally, it was very nice to see a good little profit on those before expiration. And then the last trade that we closed out today, actually, which was July 7th, is our calendar spread for the Qs. Now, the reason we closed this one out is we still have 11 days to go to expiration. And remember that we're trading the August-July 89 put calendar. So both of the strikes are at 89, and then we're playing the different months being August and July. Now, obviously, we want to focus on this month, which is July. That's ideally when we want to make our money, between now and July expiration, which is about 11 days to go. And I just don't see the Qs going back down to anywhere close to 89. So we'll go to the chart here in a second. So that's the reason why we close out this trade, is that now that we're getting into these last 2 weeks of expiration, I just don't see the Qs going back down to 89. They might have a little bit of a more dramatic sell-off here in the next couple of days, but I just don't feel like they're going to go all the way back down to 89 where we need them to be. So we went ahead and closed out this trade for a $15 credit and sold this back to the market because we originally bought this calendar spread, and took a $40 loss on each side of that trade. So again, with the Qs, I just don't see the Qs going back down to 89, which is a huge, huge drop from where they are now. And you can see the stock market would really have to kind of tank in the next 15 days or so for us to make some money on this trade. So I think at this point, it's safe to say that the Qs have definitely beat us in that one. When we actually traded this, it was all the way back here. So it was still a huge, huge rally. And so it was still a good bet that the market could continue down. But it was a small bet. It was a very bullish bet and something to keep us active. Implied volatility really hasn't even moved in this thing, which obviously helps a calendar spread, and that just hasn't moved the entire month. So at this point, it's safe to just kind of take your licks and get out of the position, save whatever premium you have now that you've kind of exhausted all the options, and it's a really, really far stretch move for you to make money, and that's what we did in the Qs. So, but this might actually be one that we kind of reload here for an August-September calendar spread. I still like it because implied volatility is low, and we're definitely getting in towards the tail end of the summer months, and we should see some more activity in the stock market as we kind of close out the summer. So I haven't quite ruled out the opportunity here to do an August-September put calendar spread in the market. I'm still a little bit bearish on where the market's going to go short term. I don't think it's going to continue going up at this rate. but you guys will obviously have to wait and see for those alerts to come out. So as always, hope you guys really enjoy these videos. If you have any questions at all, please ask them right below here. I'll get back to all of those tonight or tomorrow before the open, and happy trading.